Good morning. Thank you for joining us for today's webinar, What Does the New Stimulus Bill Mean for Businesses? Presented by Rain Associates, a top 100 regional CPA and accounting firm. My name is Imani Fields, and I'll be walking you through a few housekeeping items for today's webinar. First, if you have any questions during today's presentation, you may enter them into the chat box on your screen. We will try to answer as many questions as we can at the conclusion of today's presentation. However, to be respectful of your time, we know that we will not be able to get to them all. Therefore, following today's webinar, we will review all questions and send out the answers via email as soon as we can. If you'd like a copy of today's slides, you'll find that they're available in the handout section of the webinar dashboard on your computer screen. Today's webinar will be presented by Rain Associates Trusted PPP Task Force, Paul McEwen, Matt Long, and Doug Hauser. Paul McEwen is a principal at Rain Associates, where he leads the firm's retirement plan consulting and administration services team. He's responsible for consulting with clients on fiduciary best practices related to their qualified retirement plans. With more than 30 years of accounting industry experience, his areas of expertise include retirement plan fiduciary issues, plan compliance, and reporting issues. Matt Long, a principal with Rain Associates, oversees the firm's client advisory service practice. With more than 10 years of experience, Matt is responsible for identifying the best solutions for his clients and overseeing the execution of the team's service offerings. His areas of expertise include client advisory services, business tax strategies, financial reporting, and business consulting, particularly in the areas of restaurants and hospitality industries. Finally, Doug Hauser, Director of Construction and Real Estate Services at Rain Associates, is committed to building out and growing the construction and real estate service segments while continuing to ensure that we are known industry-wide. Doug has more than 25 years of accounting experience, and his areas of expertise include financing structures, cash flow management, succession/exit planning, and long-term capital liquidity event guidance. That was a mouthful. And now I'm going to pass it over to you, Doug.
Thanks, Imani, and thanks to everyone for joining us. Just to give a brief overview, we're going to spend some time on the PPP program, second draw opportunities, and some tidbits that we continue to learn. Obviously, a very fluid situation, which we'll get into here with that, as well as some things that we've learned through the forgiveness process with regard to 1.0 and how that dovetails in. And we'll spend probably half the time giving a high-level overview of the employee retention credit and the changes there. That's really very, very significant. Again, we're just going to touch on that from a high level today. We do have a follow-up webcast next Wednesday where we will have some of our experts on that side of things really do a deeper dive into the employee retention credit, because that is certainly very important. So that was my lead off, Matt. And Paul, do you have anything to add before we get going?
The only thing I would add on the ERC is, essentially what you're going to get in our slides today is just what the changes were, kind of a regurgitation of the law itself. We're not going to do any substantive analysis today. Our concern was we just didn't have enough time to do it justice, and it is an important topic. And so we went back and forth for a while. Do we stretch out the length of the program, or do we cut it into two different programs? And I think we decided most people want to be in and out within an hour, and so we wanted to honor that. And so we're going to do what we can, provide as much value as we can on the Paycheck Protection Program and related topics. And we'll touch just briefly on ERC, but we'll dive into that next week. And we're waiting on guidance as well. I mean, it's early days in terms of those changes. A lot of questions on the ERC program.
For sure. Well, next slide, please, Imani. Let's get going. Matt, do you want to
jump in, Doug? Or Matt?
Yeah, Matt, you want to lead us off here?
Yeah, I think this is probably what everyone's kind of been hoping for and expecting, and probably one of the biggest benefits to some of this new legislation is the deductibility, obviously, of the PPP expenses. There is no tax liability resulting from it, both for the first round of PPP funding and for the second. A lot of us were very optimistic this would be the case. A lot of us were starting to get discouraged because Congress kept dragging their feet. And to me, this is one of the most impactful and best parts of the legislation, considering this applies to everyone who applied for PPP 1.0, whereas 2.0, you know, it's a little bit more stringent in who can apply.
Yeah. And one thing to note on this too, you know, this will create obviously a significant different look with regard to GAAP financials, because again, that forgiven loan amount will show up as income on your GAAP financials. But again, the tax treatment obviously is very favorable. So there will be some explanation required perhaps for some third-party users who maybe don't follow that as closely in looking at tax returns versus GAAP presentation. Next slide, please.
That's a good point, Doug. And, you know, it's basically a tax adjustment, right? So you're going to have a book to difference essentially, and so your tax return won't necessarily reconcile back to the face of the financial statements won't reconcile back to the face of the tax return, and it will not impact the basis either. I think it's important to mention.
Guys, I would just mention that some of the early predictions on this piece of the law talked about having some conditions placed on this forgiveness tax or the deductibility of the expenses, and I was, you know, we were pleasantly surprised that there don't appear to be any conditions at all. Pretty simple.
Absolutely. So Paul, you want to address this part about under 150K? This was also long awaited. Address this in the legislation.
Sure. Then this, we were more optimistic that we were going to get this. This was just more a matter of when, not if. The deductibility was we were a little less certain about. But and we've been telling clients, if your loans are under 150,000, hang on, don't apply. It may get easier for you. Yeah, and the banks were pushing back on that because they, you know, I certainly understand they want to get these loans processed in terms of the forgiveness application. So they were putting a little pressure on some of our clients to get applications submitted. So it was a little, you know, I think some of our clients felt like a ping pong ball going back and forth between us and the banks. But we finally got this as part of the legislation. It's essentially any loans under 150,000. They're going to come out with a new form. We don't have a form yet, but it's going to be a one-page form. You just certify that you use the funds in accordance with the program. And there'll be a number of certifications that we're all familiar with, but you won't have to include any payroll documentation, no 941s, et cetera, that are required with larger loans or with the existing applications. Now you're gonna have to save all that stuff, because if you're audited, if there's a red flag or for whatever reason the government wants to see the detail, you're gonna have to be able to provide it. This isn't just certify and that's all you have to do. So we've been telling folks from the beginning, document. So that still applies, but the application process, because there is no associated documentation that has to be reviewed by the banks, it should fly through pretty quickly. Doug, you've had some conversations with banks. Do you have any additional insights on that?
Yeah, they just, again, they're thrilled with this because the less touches that they can have, the better. It's all about administrative cost and getting these processed and done. And so this makes it a lower touch program and obviously streamlines it, which is great for the recipient and the banks as well. Any last thoughts on this one, Matt?
Yeah, I'll just add that, of the couple things that you're essentially certifying and attesting to is I believe it's going to show you're going to certify that the number of employees that you retained. I think you're going to have to note that, and then essentially they're going to want to know roughly what the payroll versus non-payroll costs are for how the funds were used.
Yeah, great point. Next slide, please, Imani. So second draw loans, and we can update this a little bit. I've gotten some information last night and this morning from from senior bankers at several institutions. The hope is that the applications, or that the program will go live next Monday, which is the 11th. Now the caveat there will be that the institutions that have 10 billion or less in assets, smaller community lenders, et cetera, they will get a 2-day head start on larger institutions. So again, that's important to note. I'll repeat that. Smaller institutions will get a 2-day head start on the larger banks. That has been confirmed through IFRs, interim financial rulings, et cetera, and some notifications from the SBA. So that is the hope at this point. I hope to see at least a draft of the second draw application later today, but that's the expectation. That's where we're at right now. So we will see, again, very fluid situation, changing, it seems, of course, by the day, but that is at least the expectation in terms of where we stand now. So Paul, you want to give an overview
the only
here?
thing I would say before we jump into kind of the details here in terms of who's eligible and how much and that kind of thing, maybe you just continue with the discussion about the process. What can folks be doing now to make sure that they're greasing the skids in terms of making sure that they're that the process goes smoothly, that they're I'll say near the front of the line when next week rolls around. And I guess what I mean by that was a little vague there, so I'll help you out. But what I'm telling clients is call your lender, make sure they're going to be in for PPP 2.0. Doug, you've had those conversations with the bankers, and it looks like everybody's, for the most part, going to be back in. But make sure you're in it. There was just a lot of uncertainty and hiccups in the application process the first time through, and I know I'll create a lot of anxiety for a lot of folks. I don't think we're going to be in that position. I know, Doug, you were telling me you think it's going to be a lot smoother process this time around.
Yeah, I think the banks in general are going to be obviously much better prepared. The SBA won't be the E-Tran system this time. I will tell you that this isn't going to be an auto-approved application like it was kind of the first go-round, where we sort of termed it helicopter money. You just had to be there, and we'll get into that. Obviously, there's a lot less uncertainty right now, so they're really trying to benefit those industries that were impacted significantly. So if you submit an application for 2.0 or second draw, it doesn't automatically mean that you will get it. The bank and the SBA will look at that, and we'll get into the necessity requirement around that. Matt, you have anything to add on all of that?
No, I think you guys hit on it well. First go around was kind of a shotgun approach, new to everybody. Everyone was kind of scrambling. I think this time it's going to be much more structured. From what I'm hearing, and Doug, you can correct me if I'm wrong, the first go around, it was depending on your institution, you could submit via phone, you could submit via paper copy, portal, what have you. I think this time it's essentially going to be all electronic.
Yeah.
Yep. The last thing I would add, Doug. Yeah,
Go
one
ahead.
last thing. So basically three types of lenders that you can consider. And the third type really wasn't available the first time through. So you've got your large and regional banks, and then you've got community banks. And I think the community banks really stepped up and helped a lot of our clients in particular the first time through. So they remain a great resource. And now we've got financial technology or fintech type firms like PayPal and others out there that have been approved by the SBA to process loans. And so hopefully there are a lot more institutions out there that are willing to process these loans. That was a big part of the problem early on. So, consider all of those sources, and if you're still having trouble, you can't find somebody to help you with your loan, then call us and see if we can help.
Yeah, and we're getting some questions here, which I'll shoot to you guys here a couple of them. Just because you didn't get 1.0 doesn't mean you're ineligible for 2.0. So there's lots of things we'll get into with regard to some of those qualifications. Even if you didn't yet use all of the 1.0 funds, for example, and you were a recipient of 1.0, you still may be eligible for 2.0. There are some qualifications you have to certify that you are going to use those 1.0 funds, et cetera. We don't know what all of those details will look like, but I would encourage everybody to, again, as Paul and Matt said, get with their lender as soon as the applications become available. Now, the one thing, and maybe, I don't know if now is the best time to get into this, but the necessity requirement as it relates to this second round, I think we need to pay more attention to, and we can discuss this here. Whereas again, the first time there were so many unknowns and they were just shoving the money out there, and essentially eligibility was, let's just say, a little bit looser. I would strongly caution any business that may technically qualify. You had the 25% revenue decline, say, in a quarter, but your business is otherwise, generally recovered, and you've got other liquidity sources. I would really strongly caution you to take a hard look at this program, work with your banker, consider whether or not you really should go for this. Matt, you deal a lot with folks in the hospitality and other industries that really have been severely impacted. What are your thoughts on that?
Yeah, well, obviously the hospitality and food service industries have been impacted significantly. I guess to your point, the example I'll use is, I have certain clients that are fine dining establishments that were impacted much harder than some of my maybe fast casual or fast food type clients. And, my fast food or pizza shops, they're actually thriving and doing quite well. And while they may have experienced a decline in revenue from, quarter over quarter that actually would qualify them, right now they're looking stronger than ever. And in my mind, they probably wouldn't qualify. Whereas the fine dining example that I gave earlier continues to struggle. They're not doing much takeout just because from a price point and travel perspective. And so they really are the ones that, to me, is this 2.0 is really geared towards.
Yeah. And, there's some other questions here. Nonprofits certainly are eligible. That's included in the program. Ability to amend first tranche loan amounts, for example, that there is the ability to do that within this act. You have to work closely with the bank. I know some banks maybe aren't going to be real thrilled about, it's going to be a high touch process to try to amend that first tranche. So work closely with your bank in terms of what makes the most sense, if they can fairly easily amend that because you didn't apply for enough in terms of what you qualified for, versus maybe trying to do a second draw loan, some things like that. So there's still a lot of nuance to this, a lot to be worked out. Paul, go ahead. Sorry.
Yeah, I was just going to say, our slides get into some of that stuff, so let's just start through the slides. I think we wanted to give a nice high-level overview just in terms of the rollout of the program. And before we get into the slides too, I just wanted to make sure, provide some additional context. You got a question already regarding PPP 1.0. If I haven't applied for a PPP loan yet, can I go right to PPP 2? Technically, no. Technically, the way the act is written is you got to apply for PPP 1 first, and then you use up that. Not really a big difference there, other than for PPP 1, you don't have to have the 25% reduction requirement, right? You got just the normal requirements for the PPP 1 loan. So just make sure people understand that if you haven't applied for the loan, or to your point earlier, if I applied but I gave it back, or I gave part of it back, and now I find I do need that, yeah, you can go back and get that money and reapply for that money. But but you got to have that necessity requirement, right?
Yep.
So don't, and that's in good faith. You're making that that certification in good faith. So just keep that in mind. So just wanted to provide that additional context. So PPP 1 is still available through the end of March, and PPP 2.0 is available. And 2.0 you can't tap into until you've used up, or you think you can certify that you will use all of your PPP 1 money properly.
Yeah, great point.
So let's just jump into this, okay? So the maximum second draw. Let's go back real quick. I want to finish up that first slide. Maximum second draw loan, $2 million. Same criteria, 2.5 times the average monthly payroll cost of the framework, the interest rate, the terms. That's all pretty much going to be the same. The covered period's going to be the same. Okay, so not any changes there. You're going to be looking at 2019 payroll costs. You can look at 2020 if that's more advantageous to you. I don't know if it will be, given that 2020 was a tough year for a lot of businesses, but if that is more advantageous, you can use 2020. Actually, the law says you can use any 12-month period up to, right before you apply. So given where we are on the calendar, I would say calendar year 2020 is probably going to be the most recent, but you can certainly use 2019. And a lot of folks already use, they've got that information prepared. The lenders have that information already. Really streamlines the process if you can just reuse your 2019 average monthly payroll cost. Matt, this next provision here is really good for your clients in terms of going 3.5 times the average monthly payroll cost. I think you were talking about the impact to one of your clients just in terms of the extra dollars, and those are the industries, the clients that really need the money, and so I was really happy to see that they really targeted money to the accommodation and food services industries.
Yeah, I'll make a couple points, just to clarify. So as Paul mentioned, the max loan amount is now 2 million, whereas before it was 10. So keep that in mind. There was a little confusion about what payroll was going to be used to determine kind of the second draw program, and I was really glad to hear it could be based off of 2019 if you choose to do so. One, because from a practical matter, you probably already have those reports gathered from when you submitted the first go around, or you at least were looking at them. Two, for an easy, clean cutoff in order to determine the amount and calculate it. And the payroll amounts were likely higher in 2019 than they were in 2020. So I was really thrilled to hear that. Paul, to your point on the 3.5 times the average versus 2.5 of monthly payroll, obviously I was excited to hear that for my clients. That's much needed. I clarify there, most food and accommodation industries, within your tax return, you should have an NICS code that starts with 72. And I don't know if they're going to reference back to that, but really that code should start with 72, and there's a slew of them, but it should start with 72 to really qualify and be considered accommodation and food services. That extra, the 3.5 versus the 2.5 can equate to some big dollars, considering how labor intensive restaurants tend to be. And, just quick math and kind of roughing it, it really should equate to about, the loan amount should equate to about 10% of their sales under this 3.5 times. So it's exciting, and I'm encouraged by it.
Yeah, great points. Let's go ahead and move forward in interest of time. Paul, go ahead, give us an overview here.
Okay, and we've already made reference to the first bullet point. So you have used or will use the full amount of your first PPP loan. And if you didn't apply for a PPP loan yet, you're not going straight to 2.0. Just remember that you got to go through 1.0 first. So they did want to target second draw loans to those that really need it. So they put in some additional requirements above and beyond the requirements that we had for PPP 1.0. One of them was this 25% reduction in gross receipts. And so what you're going to be looking at is you look at any quarter in 2020, compare that to the same quarter in 2019. If you had a 25% reduction in gross receipts, of course, not including any kind of PPP money or other assistance you might have gotten related to the CARES Act, you exclude all of that. It's just looking at your actual operations, your gross receipts. If you had a 25% reduction, well, you have to have had at least a 25% reduction in any given quarter to qualify for 2.0. And then businesses with multiple locations that are eligible entities under the initial PPP requirements, they just have to have fewer than 300 employees per physical location. And I think that was really geared toward hospitality and food service industry as well, Matt. We've already said you can only receive one PPP second draw loan, and you can only receive one PPP 1.0 loan. So you got one opportunity at 1.0, one opportunity at 2.0. Again, the max loan for 1.0 is 10 million. Max loan for PPP 2.0 is 2 million. And pretty much, except for those in the hospitality and food service industries, it's going to be the same calculation in terms of 2.5 times your average monthly payroll. So here we put in blue the loan necessity criteria. Yeah, the loan necessity criteria still applies, and that's for PPP 1.0 and 2.0. I think there's a little bit of confusion regarding 2.0 because they had the additional 25% reduction in gross receipts. Was that going to be enough to kind of demonstrate, well, I must really need the money if I can meet that requirement? But think about industries or businesses that might have been impacted greatly in the second quarter of 2020, but have since rebounded and are pretty much back to normal, or maybe doing better than they were before. And so technically would qualify. I think you have to ask yourself, and what I've been telling clients is, if you think laying off employees is going to be a reality if you don't get an infusion of cash, within the next few weeks to a month, then by all means, and you otherwise meet the requirements for 2.0, by all means you should apply. I think there's no question. But the loan necessity criteria, we've got, and this is something to think about for 1.0 and 2.0. We're 9 months into this pandemic now, right? So it's the amount of economic uncertainty out there is a lot less now, and we've got, hindsight is 2020, so we can look back. We know where we've been. We know what the impact has been. We got the vaccine. It's starting to hit the market, or hit our country at this point, and it appears that things are going to improve. I mean, I realize that we're going to have to go through some dark days yet in terms of the pandemic, but I think there is a bit of a light at the end of the tunnel. So I say all that just to say circumstances have changed. So the loan necessity analysis is going to be a little bit different than it was. And so don't just assume you're going to have, if you had necessity in April, that you have the same necessity this year. And hopefully that's obvious, and you can understand where I'm coming from on that. Any other comments?
Yeah. We're getting, before I let you comment, Matt, we're getting a lot of questions about what is gross receipts. Gross receipts in the Act is defined using the IRS definition of gross receipts, which is generally all receipts. It is not a GAAP definition, so let's not be confused. It essentially all receipts of income are included with that in general. Now there are a few carve-outs, obviously, with regard to that. Matt, you have any further comment?
No, I just think to kind of to Paul's point, really question if you have the need for this funding, because I think it will get scrutinized. Where first go around, it was so much uncertainty, everyone could kind of make the argument, I'm eligible, I need to apply. This time it's much more bright line, it's much more defined.
Yeah. Yep. So with that, Monty, let's move forward. So again, this is a big one. We continue to emphasize this, and the bankers I've talked to emphasize this too. The loan necessity part of this will be very much in play for 2.0. So we don't yet know how that's going to quite be defined in the application. We will see, but make sure you work closely with your banker in that regard and really consider whether this second bite at the apple is necessary for you.
The only thing I would point out on this slide is the third bullet point there. I don't know how many farmers and ranchers we have on the call this morning, but in many cases, they're able to, if they're a sole proprietor, they're typically not showing a whole lot of net income at the end of the year in many cases, and so they kind of change the criteria there to be based on gross income rather than net income from the business, which was a nice change for farmers and ranchers.
Yeah, one of the questions we get a lot are for not-for-profits, what's included in gross receipts. So grants, things like that, those are all included in gross receipts from a tax definition. So yes, it's our understanding that that's how it will go. Again, we only have an interim final ruling on that now, so we'll have to wait and see the final application, but I would assume that that's going to be the case. Anything else on this one, Matt? All right, Imani?
You guys hit on it.
This is important, Matt. If you can cover maybe some of these additional costs that are allowable now in this 2.0.
Yeah, I think they've expanded what is eligible expenses, so I think it's important to know what those are. And you can read here, there's additional expenses, some related to payroll, some related to damages or just the additional cost of operations. From a practical matter, I think that because the covered period is now potentially 24 weeks versus the 8, that it's not as important because most folks are going to be able to use all of the funds for payroll specifically. But with that said, this does add a little bit of flexibility on kind of what is eligible expenses.
Yeah. Paul, anything to add on this?
Yep. No, I do. Matt covered it well. What I like to do is just add a little more definition around some of these bullet points. Again, going to the 24 weeks, most of our clients have been able to use payroll costs to cover these, and there is still a 60% requirement. 60% of the loan proceeds have to be used on payroll costs, so can't lose sight of that. But for those businesses out there that have a lower payroll, that maybe are less payroll intensive than other businesses, these are perhaps helpful. So let me just read real quick. I have some notes here. It was too much text to put on the slide, but so for covered operations expenditures, we're talking about payment for any software, cloud computing, or other human resources and accounting needs. For covered property damage costs, we're talking about costs related to property damage due to public disturbances that occurred during 2020 that are not covered by insurance. So that's kind of getting back to maybe some of that social unrest in some of our cities. Covered supplier costs, expenditures to a supplier pursuant to a contract, purchase order, or order for goods in effect prior to taking out the loan that is essential to the recipient's operations at the time at which the expenditure was made. Supplier costs of perishable goods can be made before or during the life of the loan. And then covered worker protection expenditure definition is personal protective equipment, so PPE and adaptive investments to help a loan recipient comply with the federal health and safety guidelines or any equivalent state and local guidance related to COVID-19 during the period between March 1 of last year and the end of the National Emergency Declaration, which I think we're still in. So just wanted to add that additional detail. We didn't have room for it on the slides.
One other quick note, we keep getting a lot of questions about gross receipts, and this is a big issue. Significant BWC dividends went out in December for a lot of companies in Ohio. Under the definition, those BWC dividends would be included in gross receipts as we understand it at this point. One of the things that would not be included there would be the proceeds from PPP 1.0 as we understand it. So just some clarification on that. Matt, anything else to add?
No, I don't think so. I think we've hit on this.
All right, let's move forward. 501c6. Paul, you want to touch on
this is
this?
a big one. Yeah. I mean, we had a lot of 501c6 organizations asking us if they were eligible under PPP 1.0, and they weren't, but they are now. So these are your chambers of commerce, your trade associations, things like that. So this is a nice one to add to the eligibility list. Just a few things, some bullet points there to be aware of. The organization must not receive more than 15% of receipts from lobbying. Lobbying activities do not comprise more than 15% of the activities, so not just receipts but activities. The cost of lobbying activities of the organization do not exceed $1 million during the most recent tax year. And then of course the organization, that's the same as all other organizations, fewer than 300 employees. So I don't have anything else from either of you guys on that one.
No. All right, let's move forward.
All right, so I had a special request from one of our principals yesterday that we make sure we cover this. I think there's still some lack of knowledge out there, so I'm just going to jump into it. But part of the CARES Act initially was to provide debt relief on non-PPP SBA loans. So if any small businesses out there had SBA loans on the books heading into this economic crisis, what you noticed, even you didn't have to. The nice thing was you didn't have to do an election or anything, so it just happened automatically. But you probably noticed that you didn't have to. The SBA essentially started making your principal and interest payments for you, and that was to last for 6 months. And so we up until we got the stimulus bill, that forgiveness, those payments that were being made on your behalf or on your business's behalf were going to be taxable as forgiveness of indebtedness. And there was no provision in the CARES Act to undo that like there was on the PPP side. But in the stimulus bill, we got that. Congress went ahead and just threw that in. Just another small benefit to help businesses that are really struggling. Why tax these benefits when that's kind of the last thing businesses really need? So the other thing was that some of these principal and interest payments have been extended, and there's been a cap of $9,000 per month placed on them going forward. Not retroactively, but going forward. And businesses, again, probably in the hospitality and food service industries, those that have been hit hard, an additional 5 months of debt relief for existing SBA loans. And the nice thing is you can go out and apply for SBA loans, assuming you meet the underwriting requirements to receive them, and you'll receive this same forgiveness even on new loans. So it's not just existing debt, it's new loans too. Doug, you look like you want to say something.
No, that's important because I think the SBA, they've done really a good job trying to make some of their traditional loan programs more flexible. And talking to some of the bankers, they've really want to encourage folks. If you haven't looked at that in a while, it is another good option here for folks that really need assistance. Matt, you got anything else to add on that?
No, I just make sure we're clear. There's a lot of different types of SBA loans, and there's a lot of different types of conventional loans. And these, it's got to fall under the 504-7A criteria in order to qualify for this subsidy, essentially. I know I've had clients reaching out wondering while some of their payments were being made while others weren't the first go around, and had to kind of explain.
Yeah, good point. All right, let's move forward, Imani. This is a big point. Paul, you want to touch on this briefly?
Yeah, this was a nice Christmas gift. I wasn't expecting this at all. But EIDL advances, those those advances that you don't have to repay that were up to $10,000. I think it was initially at $10,000, and they kind of refined it because the funds started to run out. They limited it to $1,000 per employee, but a lot of our clients got the full $10,000 on these advances. And the understanding when you got it was you weren't going to have to pay it back. And then all of a sudden, got the guidance that said, oh no, you got a PPP loan, we need to coordinate that. We don't want you double dipping and all of that. Well, the stimulus bill came out and Congress basically clarified they didn't want that interpretation. That was something that SBA and Treasury came out with after the fact. And so kind of like changing the rules on the deductibility of the PPP expenses, they added this provision as well. And I know the bankers were ecstatic about this too, Doug, because what was happening was people were meeting all the requirements for their PPP loan forgiveness, and then they were having to deduct from that loan forgiveness their $10,000 advance. And so they ended up, unless they had $10,000 check to write to the bank right then, they were ending up with a $10,000 balance on their PPP loan. Well, all that goes away, and it goes away retroactively, which is nice. And I have had some clients reach out to say, hey, I already got my forgiveness, and they netted off that payment. What do I do? Well, I don't think you need to do anything. It never hurts to talk to your banker. And maybe, Doug, you've got some insights on that. But I think, based on my reading of the law and the guidance we've gotten so far, which isn't much, the bankers or the banks are supposed to kind of follow up on this. And SBA is essentially going to then pay off that $10,000 loan that remains at the bank. So what you end up being able to do is take advantage of both programs. So hopefully I explained that well enough. Doug?
Yeah, no, I think you covered it well. All I would add to that is be patient with the banks. They're overwhelmed with a lot of this, so it may be a while till they get to this piece.
Yeah, it could potentially muddy things up a little bit if you've already applied for forgiveness, or if you've already paid that $10,000 back, that back. The one thing that I just want to make sure we're clear on is if you actually went through with the loan and not the advance, you still have that loan and are liable for that loan. So I think that's important to note too.
Great point, Matt. Yes. All right, Imani, let's move forward. We'll get into the ERC here with the remaining time, and then hopefully have some time for some Q&A. Go ahead and move forward. Paul, you want to lead us off here?
Yeah. And again, this is more of an advertisement and a teaser, I think, for our webinar next week. But just want to hit this real briefly so that we have as much time as possible for questions today. So a reminder on the 2020 provisions related to ERC. It's a refundable tax credit equal to 50% of up to $10,000 in qualified wages per year. So in other words, if you had an employee that you pay $10,000 to, 50% of that would be $5,000, and the wages had to be paid between March 12th and the end of 2020. But you had to qualify for that. So you had to have operations that were either partially or fully suspended due to COVID-19 health mandates, or you had you could document that you had gross receipts during any calendar quarter that were less than 50% of gross receipts for the same quarter the previous year. And then, of course, once, this is a great example of, we all thought back in March that we would kind of get through. It would be about a 3-month period. We'd get through this pandemic and be no big deal. We just had to kind of shut down the economy, get this virus behind us, and then open everything back up. That was hindsight being 2020. That was a little optimistic, obviously. So there was a provision here that said essentially when your gross receipts rose back above 80% of the previous quarter, then you basically, the credit ended. So those were the rules in existence prior to the stimulus bill. So just wanted to remind everybody of that. And we had, and I guess the other thing was ERC was mutually exclusive with PPP, right? So the vast majority of our clients utilized PPP, so they just kind of disregarded the employee retention credit.
Yeah, and that's the huge part. No longer the case. You can take advantage of both potentially.
Yep.
Let's move on.
So these are the new provisions for 2021. And essentially what the stimulus bill has done is it's extended the employee retention credit for the first 6 months of 2021. So I said Q1 and Q2 of 2021. But the credit rate has been increased from 50% to 70%, which is nice. So, you know, under the old rules, up to 5,000 per employee, and this would be 7,000 per employee for the year. And then the limit on the per employee wages is increased, and this is huge, is increased from 10,000 for the year to 10,000 per quarter. Now you got to remember, this isn't going to be the entire year for 2021. This is just the first 2 quarters. So essentially they've doubled the wages that are going to be eligible for this credit, and they've increased the rate, the credit rate. So basically went from 5,000 eligible last year to 14,000 essentially in 2021. These provisions apply to 2021. There is no retroactive change to 2020 for these provisions. Okay. What did change, and this is where the complexity comes in, and we're not going to get into it today. We don't have time. But what did change is the stimulus bill said, oh, and by the way, back in 2020, we said they were mutually exclusive. Yeah, well, forget that. You can do both. But you can't use the same wages for forgiveness that you're using for the employee retention credit. So there's a lot of complexity there, and we're still, frankly, digesting that. But don't think that when you go back and do a retroactive bite at that apple on the ERC that you're going to get the 70% and the 10,000 per quarter. You're not. Those rules apply in 2021. It's just that back in 2020, the ERC and the PPP programs are not mutually exclusive. So that might be a source of revenue if you otherwise qualify for the employee retention credit. So you take a look at this. So just continuing on down. Oh, go ahead, Doug. I'm sorry.
Oh, go ahead. I'm sorry. It's to say, Matt, you dealt with some of this a little bit with some clients. Any thoughts to add here?
I think we're all just still trying to understand it, right? I think this, Doug, and you had mentioned it earlier off before we had joined the webinar, but it's kind of a good reason to have a payroll provider, number one. But secondly, I think there's a lot of confusion around this, and it's important that the point Paul had made there, that yes, they are not mutually exclusive, but you can't kind of still double dip. And so there's going to be a lot of analysis, and there's a lot of mechanics that go into determining, one, is there a credit available, and two, what is that dollar amount? And you know, the payroll providers can certainly help with providing some data, but they do not know what your PPP loan was. And so they're not going to be able to just basically say, here's a blanket credit that is available to you.
Yeah. Paul, anything else to add on this?
Yep,
this
that's a great point. Great point. Yeah, so let's look at that third bullet point. So the gross receipts eligibility threshold for employers, if you remember, under the 2020 provisions, was you had to have a 50% decline. You were either partially or fully shut down because of health mandates, or you could document a 50% decline in gross receipts. Well, that has been reduced to 20%. So what they've really tried to expand the number of employers that are eligible for the ERC in 2021. Okay, again, this is 2021. Okay, just want to make sure if you can't remember, just look at the top of the slide. But these are provisions for 2021. The 100 employee threshold for determining qualified wages. It used to, under 2020. This is kind of a fine point. And doesn't. Most of our clients have fewer than 100 employees, so they any wages that were paid for their employees were eligible for the credit. Under the old rules, if you went over 100 but fewer than 500, you had essentially only employees that you were paying not to work were eligible for the credit. But they've expanded that. They've gone from 100 to 500. Again, really trying to push money out and make more companies eligible and make the credit bigger, more generous. So I think this is something every business needs to take a look at to see if they can get something out of it. And then the last point there, the bill clarifies the determination of gross receipts for certain tax-exempt organizations and the group health plan expenses can be considered qualified wages even when no wages are paid to the employee. So a lot of folks were put on, laid off, but they continued with their health insurance. So those health costs are considered wages.
Yeah.
So,
We continue to get a lot of questions around gross receipts, and I'll reemphasize again that the documentation we've seen, this is contained in the interim final ruling that came out last night. Gross receipts is defined using the IRS definition. So it's the definition of gross receipts that you typically see on a tax return. So that, you want to work closely with your accountant and the bank to make sure you have a proper understanding of that. For example, going back to the BWC dividends, there was a dividend declared and received and paid in December. That is different, for example, than the earlier BWC rebates, which were issued earlier in 2020. So you got to be very cautious when you're looking through the definition of gross receipts, for example. Those earlier two BWC rebates are rebates of expenses, whereas the one paid in the fourth quarter in December, that was truly a dividend. So very different in terms of that. So you really got to make sure you are capturing the right information when you're looking at gross receipts. All right, let's move forward.
So I think this is our last slide on ERC, and we've really already hit these points. The first bullet point there is really just, the two programs, ERC and PPP, are no longer mutually exclusive, but you can't use the same wages for both PPP forgiveness as well as the ERC credit. So I think for most of our clients, that's not going to be an issue. Again, we went to the 24-week covered period on the PPP loan, so most of our clients had lots of payroll costs, way more than they needed to get full forgiveness of that loan. So there should be wages available for ERC, but it's something we got to pay attention to. And then that last bullet point, just those retroactive changes, just really going to hammer home. Those retroactive changes, only apply to the mutually exclusive piece of the ERC and the PPP. So
yeah,
I think we hit that.
Matt, you got anything else? Anything else to add on this one?
No, I just, there's, we're obviously waiting on additional guidance here. I just want to emphasize that I think this is going to be a complex exercise. When you factor in your PPP and the sourcing of those funds, did you use it all for payroll? Were you at that 60-40 split? How was it used? And in factoring that into determining this credit, it's quite intensive.
Yeah, and to that end, I'll remind everybody again, we're going to have a separate webcast on this next Wednesday where we'll get some of our tax experts and payroll experts on, because this is a little bit out of the field of expertise for Paul, Matt, and myself. We know enough to be dangerous on the ERC, but as Matt said, it's so complex, you really need to have the right expertise involved in looking at that piece. With that, let's move forward. We'll give it maybe a statement and then take some Q&A. So one of the things I want to go back to and emphasize, we've gotten this question a little bit. We continue to monitor this. It's a fluid situation. Initial understanding is, again, that the community banks and any institution, any lending institution with less than 10 billion in assets will hopefully go live with PPP 2.0 or second draw, however you want to term it, next Monday, which is January 11th. All other institutions, all other lenders will then follow 2 days later. There will be a 2-day head start that the SBA wants to give to all community institutions. So that's what we know at this point. Again, very fluid situation, may change, but continue to monitor that. Matt, you want to make any final comments before we take some Q&A?
No, I think, you know, there's a lot to digest through this new legislation, and all in all, you know, big picture, it's very, very favorable. I mean, you're getting the non-taxability of the PPP 1.0 and 2.0, which we all were hoping for, and is huge, and I think is maybe understated. The 2.0 program itself, or the second draw program itself, additional 7A, SBA 504 7A relief there, and then these favorable ERC credits. There's just, it's, to me, it's much better than what even I was hoping for.
Yeah. Paul, any final thoughts?
No, I think you guys hit on it pretty well. Let's see if we can answer a couple questions.
Yeah, we'll go ahead and hit some questions here. Let's see. Confirm the date. I think we talked about that. Grants and other things like that, would they be included in receipts? I would, you know, the answer is yes.
Yep.
Again,
For nonprofits, I assume you're talking about.
Yep.
Yep.
Just to clarify, PPP2 loans, yes, they are forgivable. Again, to go back to some of the definitions here, all the definitions about what is payroll, all those things, none of that stuff has changed. They really haven't changed any of the defining details around that stuff. It's just kind of an expansion of the program. You guys have any other comments on that?
No, the framework remains very similar.
Yep. Yeah, my expectation, the mechanics of the calculation are going to be pretty much the same.
Here's one we get to, you know, okay, well, are they looking at, when you're looking at the decline in revenues, the 25% decline, you know, how do you measure that? It is going to be on a calendar quarter basis. That's the understanding that we have. So you're going to have to show some proof of that, obviously, and the banks have been charged with being the arbiters of that. So again, you'll have to work closely with your lender in terms of providing the right proof as far as that goes. Now, there is a caveat. I know if the revenues declined, you can use your tax return if you have it, which is an annual measure, but if it shows an overall decline of 25% or greater, they'll kind of give you a pass. Obviously, if the whole year declined at least 25%, we're not going to worry about an individual quarter. You guys have any other insight in terms of the details or stuff as it relates to that?
No, I think you said it very well.
I just encourage clients and these businesses to start doing this analysis now to see if they meet the criteria, and then really think hard about the necessity piece that we hit on earlier. But be proactive and looking at this stuff now so that you can kind of be first in line if you are eligible.
Yeah, absolutely. I think, and again, the overarching theme here is I think the banks are much better prepared to deal with this this time. They've got a process and a system better aligned to help folks. I think there was, you know, there was a lot of confusion last time, and it was sort of, you know, who did you know and how well you could connect. I think it'll be much more smooth and straightforward this time. So, you know, hopefully that's the case and folks can get the help that they need. Anything else to add, gentlemen, before we wrap up? I know we've got a couple minutes here.
No, I mean, I think to me that just thinking philosophically about that necessity requirement, and I don't know that did we talk about the $2 million and under caveat to that? I mean, we did get some guidance relative to PPP 1.0, which is applicable to 2.0 as well. For loans under $2 million, there's kind of an assumption that it's deemed necessary as long as you're applying in good faith. So, you know, if for 2.0, if you meet the 25% reduction and any quarter during 2020 in terms of gross receipts, then I think you just need to consider whether you can apply in good faith that you need the infusion of cash. And I tried. Again, the question I ask clients is, if you don't get the money, are you going to lay people off? Because that's the point of the program. I mean, paycheck, it's called Paycheck Protection, right? So it's supposed to keep people on payroll. It's not supposed to be a source of funding so that you can go build a warehouse or expand your footprint geographically or whatever. It's not for growth. It's for keeping people on payroll. So anyway, keep that in mind. That's really all we're telling.
Great point. Matt, you have any final thoughts?
No, I would. I think we hit on everything that I thought was important there, and there's still a lot of guidance that needs to be issued. Still a lot of confusion and clarification that needs to be had, and so try to stay patient with it. At the same time, be as proactive as you can with getting kind of your house in order to be prepared.
Yeah, absolutely. Great point there. Be patient. The bankers are doing the best they can. Work with your CPA. Employee retention credit. There's a lot of complexity as we discussed around that. Again, we'll have another webinar next Wednesday on that subject. But there's still a lot of nuance to the PPP. I know quite a few folks have gone through the forgiveness process or in the midst of that. Again, be patient with that as well. Everybody's doing the best they can. You got to make sure that you provide the right information in terms of that payroll detail or whatever's being asked, and work with your lender, and they'll, they want the same thing you want, which is to get it forgiven. So remember, we're all on the same team here in this process. All right, well, thank you all. And Imani, anything else to add as we close out?
No, I think you guys handled it. Just make sure you guys register for our webinar next Wednesday. I believe it is at 11 o'clock. Abby has put some links in the panel for you guys. So thank you for joining us for today's webinar on what does the new stimulus bill mean for businesses. We hope that the team was able to provide you some valuable insight in regards to best practices and potential solutions. If you sign off today and realize that you have additional questions, you're always welcome to reach out to Paul, Matt, and Beth directly. And thank you guys, and we hope you have a great day.
Thank you, everybody.
Thanks, everybody.